Hey, Job here. On this channel, I invest 100% of my income to create monthly cash flow. This cash flow will eventually replace my salary and pay for all my monthly expenses. I'm not quite there yet, but I'm already making 5.4K a month or so for my portfolio and have about 7 to 9K a month in monthly expenses currently on like a normal month. I'm able to invest all my income and live out of my Robinhood brokerage account by paying bills on margin. I've been doing this for over a year now, since the end of May 2025. And today we'll be going over the week 61 portfolio update since I started the strategy. I'll go into all the details of my performance this week, breaking down how I slightly underperform against the S&P 500 this week with my 1.01 total return loss. I'll check in on my margin health as usual, just to make sure everything's good. All my dividends received. Go through some portfolio thoughts that I've been thinking about this week, and end with answering a question from the comments on my last video, instead of the usual finance video of the week that I thought would be kind of just worth sharing. So yeah, all that said, you'll get radical transparency on this channel, whether the market is up or down. And like this week it's down, for example, and I'm not going to shy away from showing that. You'll see all my real numbers and see exactly how much skin I have in the game for any given position. If you appreciate all that transparency, make sure to give a like and subscribe. And then as usual, just a quick disclaimer, this video is for entertainment and education purposes only. I'm not a financial advisor and nothing here should be taken as financial, investment, or tax advice. So make sure you have a good read of this whole disclaimer. As far as my weekly flow of like kind of how I live out of my Robinhood brokerage account and invest 100% of my paycheck, you can pause and check out this full chart here. But otherwise, you can also check out a deep dive video at the top right if you haven't seen this before and you're new. And let's just get started. So if we pop over to Robinhood, we can see that, yeah, a bit of a red day on Friday. We were down 1.86% or 4K. If we look on the week, right, like I said, I was down 1.01% or 2.2K. So ended the week at like 215.5K for the portfolio. On the month, definitely red. Definitely been just going down over the month. So down 10.8K or 4.78%. On 3 months, I believe I'm still positive here. Yep, 14.9K or up 7.46%. And then year to date, yeah, still positive there. So up 17.41% or 31.9K. So, and also just as a reminder too, what Robinhood shows on this kind of main timeline for the investing account, right? This is total returns. So this includes gains and losses, realized and unrealized, margin interest that gets deducted, dividends. So it's fully total returns. What you don't get total returns on is individual positions. So like if you open, say like this AVLV position, right? Despite what it says, so Robinhood says like total return here, this is actually not total return because it doesn't factor in any dividends or anything like that. So just something to note because it's a bit inconsistent between kind of the timeline and when you look at individual stocks. And then if we go to all view here, so all time up 22.14% or 39K since I transferred over to Robinhood. Overall, definitely struggling on the month. It's been a rough month. And just since the beginning of June, really, it's been a bit of a downtrend. We're kind of seeing it here. So chopping sideways and then kind of down. So, but honestly, we've been on such a crazy run up since the end of March that like it's bound to correct a little bit. So I kind of welcome it a little bit. Definitely sucks to be in the red, but it is nice to kind of buy stuff on the cheap week to week. So I'm kind of excited for next week, honestly, for my weekly paycheck to be buying stuff into Lowe's. If we pop over to my spreadsheet to kind of take a deeper dive, look into things. So we can kind of see here, if we add up all the positions, so all the assets in the portfolio, that adds up to a gross value of 414.6K. Then margin used, I'm sitting at just under 200K, so 199.6K, and net value sitting at 214.9K. So roughly what you saw in Robinhood, but kind of minus the after hours that Robinhood shows. And we've definitely been bouncing around in this kind of like 415K range. Like if we pop over to actually just my playlist. So if you didn't know, right, I have a playlist for all my portfolio updates. If you ever just want to zone out and just listen to update after update, this is a good one to check out. But since I've been doing kind of like these heat maps, it's been nice to kind of follow along here. And then since I've kind of re-added the gross balances, so we can kind of see that I've been kind of bouncing off the top here. Like the 422K is kind of like the all-time gross high. We're bouncing off that. We haven't quite gotten past that yet. So we'll see. So even though the last week I was at 411 and this week I'm at 414, so a little bit of a jump, which is nice to see. We'll see if despite that it'll keep going. So that's for the overall numbers. As far as kind of how it's split between total returns and unrealized gains, so we can see that there's a lot of red that got introduced over the last few weeks and the last month, really. So one of the usual suspects, or that's definitely just been always in the red for the last little bit since the Iran war broke out. DRAM kind of just keeps dipping further, and with kind of like the pressure on tech this week and semis in general, this has gone down as well. And then also there's just been trouble in Korea and their stock market with kind of SK Hynix and Samsung, which are like their two biggest stocks right now. Everything else staying in the green. AVLV still a very fresh position, so just slightly in the green here. So BCAT is kind of starting to dip in the red here. This is potentially becoming a good buying opportunity for it next week, potentially. YMAX and ULTY just kind of dipping further in the red here. But again, I'm not really investing in these right now, just kind of collecting its dividends and reinvesting it in the portfolio into safer yielders. TDAQ and TSPY just holding on total return green here, but TDAQ has kind of dipped in the red here on unrealized gains. So it's signaling it's a good buying opportunity right now for that. OVL definitely been struggling along with kind of SPY going down. And Goop here, Google had a tough week this week. Yeah, they had their first negative free cash flow in years just because of their AI CapEx spend. So the market punished that like pretty hard. So I bought a little bit of the dip of this week, which was nice. If you're like in the Discord, you can kind of see all my trade alerts, and bought a little bit of that dip with an early buy of my Gumroad earnings. And by the way, if you want access to the Discord community, just great little community that we have here of just like-minded people living out of their brokerage account in different ways. It's only $3 a month on either my YouTube membership or my Patreon membership. So great little community you can join here where we're like 450 strong roughly. But yeah, that's Goop. And I'm kind of treating this as my holding that I put all my YouTube related income towards. So it's almost kind of like a tracker stock in a way. So far since I started YouTube, I've made 4.5K or so, which is nice. So excited to buy more of this dip and Goop as more YouTube income comes in. I'll be definitely throwing in there. MLPI has had a good week this week as well. That signals that war is starting to kind of flare up again. Oil prices are rising, so by proxy is rising as well too. And then KGLD and KCOP definitely still struggling overall, but they had a little bit of a good week that we'll see in the heat map a little later on. And GIAX kind of going down. I've been buying a bit of the dip there, and blocks and BTCI just struggling alongside crypto, right? So that's how stuff is looking. As far as the overall total profit, though, still positive on both sides of the coin, just barely on the unrealized side. But total profit overall, I'm sitting at 96.4K. So that's total returns, or that's realized gains, unreal dividends received, and all that against the margin value. So up 96.4K or 44.89%. So total returns very nicely in the positive here, right? On the unrealized side, we're just about to crest over to negative here. But if we go off the realized gains and losses and unrealized gains on margin, I'm sitting at just a 1.3K gain right now, or 0.65%. So really nothing. So if next week keeps dipping, I'm definitely expecting to see this column in the red here. So we've been in the green for the last few months. It's been nice, but as I've kind of been mentioning, like given how much stuff has gone up, right? There was bound to be some sort of a little correction. So it's here now, and yeah, we'll just keep buying through it. For me personally, that's how I'm approaching it. As far as how stuff is split between growth and high yield income, I'm sitting at 44% in growth, so 185.1K, and 229.4K in high yield income, so 55%. So that's what makes up the 414.6K, right? As far as my margin health, so things have come down with the market coming down. My equity sitting at 51.85%, so definitely getting close to that 50% mark, where we'll have to be more careful once we reach that point. And yeah, gross value, margin used, net portfolio value, that's all the same that I've mentioned before. But one thing to keep in mind is that if we take my blended margin maintenance ratio, so all my positions are actually 25%, which is great. That's one part I really love about Robinhood. And apply that to the gross portfolio value, right? That gives you 103.6K. So this is what my portfolio value would have to drop to, basically the 214.9K to basically trigger a margin call. So that's essentially a 111.3K buffer. So according to Robinhood, that's like a 51.78% buffer. But as I keep mentioning every week, I don't like going off this number. It just makes you feel safer than you are. This is what you see in Robinhood. And personally, it's like this doesn't give the full picture as far as the amplification. You're just like, oh, that like a 51% drop won't happen on my normal margin portfolio, but it's actually very easy for that to happen because you need to actually multiply your gross margin buffer to actually get your 51%. So really my gross margin buffer is sitting at 26.85%. So definitely dipping down, right, with the market. And so that's essentially like all the positions, right? Because this is all the money that's at play in the market and the gross value. So if that were to drop, so if this 414K would drop 26%, that would be the equivalent of a 51.78% drop, right? Like that's kind of roughly the leverage multiple, right, of my portfolio. So if we kind of take the 26.85% times 1.93, you kind of get close to the net margin buffer, right? So I think that's the thing that this misses, right? It's not factoring in all the amplification that happens. So yeah, and how I got this leverage multiple is by basically taking like my gross portfolio value divided by my net portfolio value. So this has kind of gone up a little bit as stuff has dipped as well. So over time, hopefully just kind of get this down as the portfolio grows and as I keep putting more money. But yeah, just keeping a close eye on this because this is the big indicator. Everything that's like hot green is like ones I keep a close eye on. As far as the buying power, I'm sitting at 80.3K. So you get that by doing your margin total minus your margin used. So, and then if you take half of that amount, that's basically the cash available for withdrawal. So this is cold hard cash I could withdraw from the portfolio if I wanted to. So 40.1K, but you could either withdraw 40.1K or you could actually invest 80.3K, right? So for every dollar that you have in the portfolio, they'll give you that equivalent in margin. So that's why the buying power is doubled there. But as I mentioned, I don't want to use the max amount of this and be kind of fully margined. Like I want to keep that buffer high and keep very far away from a margin call. So that's why I kind of monitor this weekly. And then that's why I kind of give an update on this because it is a risky strategy. I'm not shying away from that, but it takes monitoring. It takes like, you can't just kind of set it and forget it. So that's why I pay close attention to this. As far as my monthly income, you can kind of see that this week it's actually dipped just because I kind of ran the projections again for the averages. So that's when I update basically all these dividends, right? So as a reminder, for any of the monthlies, so XPAY, TDAQ, TSPY, OVL, etc., I basically take the last 3-month averages of payouts and average them out to kind of get the rough number there. And then for the weeklies, I do the last 4 weeks. But maybe this week it kind of made me think that like maybe I should actually extend that to be the same as the monthlies, just do 3 months, just so it's a little bit more of a realistic picture for the weeklies. Just because like, yeah, why this went down as much is like things like Chippy, for example, right, has kind of come down quite a bit, right? And with that along has come down its payment. So if we look at Chippy, so this has come down quite a bit from 58% positive to 24. So its payout has kind of gone down accordingly as well too. And so that's part of why this payout has come down some compared to the 5.8K we saw last week, just because the weeklies like was just going off the last 4 weeks. So in the last 4 weeks was actually pretty positive before the recent downtrend for it. So I'm thinking maybe I might have to rerun it with like the weeklies, also just put on even footing with the monthlies, just maybe run it for like 12 weeks instead for the 3 months. So that might maybe give a little bit more of a closer average for the kind of monthly dividend, but sitting at $5,494 a month that I'm bringing in with the portfolio. So that's roughly 65.9K a year, 1.2K a week, and $180 a day. So that's roughly a 28.74% distribution yield. And that's if you go off only the high yield assets in the portfolio, so the 229.4K. So it's just kind of nice to see how much exactly those assets are yielding. If you go off the full portfolio value, including the growth, the portfolio distribution is actually sitting closer to 16.16%, which feels more sensible. Yeah. And again, this is not free, right? Like this is debt against a portfolio. I'm taking loans against full asset value of my portfolio, 414K, and I'm paying a 4.5% interest on that. So I'm paying $744 a month in interest to hold that margin, right? This full 199K margin balance. But as you saw, I'm paying $744 a month. But with the portfolio, I'm making 5.4K a month. So it's a pretty big positive margin spread. I'm making a 4.7K positive margin spread. So basically a 24% yield essentially after margin interest. So which is nice. So like, I don't know, worst comes to worst and I have to stop investing in a portfolio for some reason, stop pulling money out, and I need to use my salary for some sort of emergency. It is nice to think that like, I could just kind of let portfolio go in the background and then like the dividends will be paying down the margin balance and still helping it grow despite me not contributing at the time temporarily. So it's kind of nice as an emergency valve that's there. So like this spread, right, would still be going down and bringing down the principal if I were to do nothing, but I'm actively doing a bunch of other stuff. Yeah. So that's where the numbers are sitting at. If we pop over to Snowball and check how the categories are doing. So this is a little bit more of a more granular breakdown compared to what we have in the sheet, just to kind of see exactly what each category is yielding and where we're sitting. So growth anchor ETFs. So this is all my growth ETFs, right? So QQM, VGT, SPMO, VU, AVLV, DRAM. Very positive, up 48.93% or 57.7K. And under the hood, I actually kind of just rolled in like all the old single stocks that I had. It used to be its own category, just so we have a good picture of like how much the growth has kind of contributed to the portfolio over time, right? So a lot of realized P&L here from all those. And then for my high yield anchors, sitting pretty positive as well. So up 8.79% or 11K, and just pretty much at its allocation value here. So all the monthly payers that are a little bit safer, that are between the 10 to 20% yielders. So XPAY really leading the pack here. VL fairly new, but slightly in the red. Goop very in the red, and BCAT and KCOP here in the red as well. But most everything is in the green here, even with the dip. And then the ultra yielders here, despite the dip, still green overall if you factor in dividends. So up 6.22% or 7.4K. But you can kind of see that there's some erosion here. So like on the high yield anchors here, I'm just a little above the cost basis here, 125 to 126K. Over here, you can see that I have 120.3 cost basis, but it's eroded. So this is kind of like NAV erosion that you can kind of fully see. And a lot of that is driven by kind of like YMAX, ULTY, BTCI, GIX, and blocks are fairly new, but I kind of fully expect these to, once there's a bit of more of an upswing, these can kind of actually come back up because of their credit put spread strategy, right? And then also kind of leading the pack is still chippy, and this come down a lot as I've shown, but still good overall. It's maybe getting to a point where like maybe I'll buy a little bit more of it, maybe with some cashback buys or things like that. So, or maybe even just during one of the weekly buys, we'll see if it keeps coming down some. But keeping an eye on it, it's definitely getting into that range right now. And on my hedge side, so 48.4K of that. So that's CLSE, IALT, ORR, KGLD. So KGLD and OR very in the red here, but CLSE and ILT holding up nicely. ILT, as I mentioned, has just kind of been nice to see. Like it's chopped sideways a little bit as the month has gone on. It actually has gone up a little bit, but the Iran war started off in the middle of this chart here, and you don't even see it, right? You don't even see the dip. Is it maybe here? But it's just kind of kept its strong march up. And it's nice to just kind of like invest in a lot of alternative things, a lot of international things. That's kind of helped it just be a little bit more of a hedge for the portfolio. The goal for this part of the portfolio really is to hopefully for this to not move too much, right? Kind of just stays around this kind of 48K range, right? Around 10% of the portfolio. So that's up 4.81% or 2.2K. If we go check on the growth side of things. So I'm noticing this week that the Snowball's a little bit off here compared to Robinhood. So like I was down 1.01% on the week, right? And then VU, if we pull that up, was down a little bit less. Yeah, down 0.7% on the week. So underperformed by 0.3% there. But for some reason, Snowball's showing the opposite. So I'm not going to look at these charts so much for that trend, right? Because it's kind of off. But well, I think the heat map's still pretty valid. You can kind of see that it's been a bit of a mixed week. So from kind of glancing at things, you can see how like MLPI did a bit better this week, but still ended up kind of neutral. Momentum still had like a good week with SPMO and large cap momentum. XPAY ended up underperforming on VU. Chippy had a little bit of a green week. Same for AVLV. CLSE kind of held steady, roughly neutral. QQQM down 1.6%. But TDAQ actually slightly outperformed it, which is cool to see. TSPY didn't quite do the same against VU. So I feel like this happens more often than not. You kind of see TDAQ holding up better against its reference index. OVL went down a bit more than SPY here. And that's by design. Right? So that's one thing with the credit put spreads is that they do have uncapped upside, but when there are down days, like it'll get a bit harder than its reference. Trade-offs, right? Nothing comes for free. So you're kind of trading that capped upside for a little bit of more downside risk compared to like covered calls where you have capped upside, but then you have the same downside risk as like the reference index. So ULTY down a little bit more than VU this week. VGT held up okay in the green. Metals did okay. KGLD and KCOP kind of went up nicely this week, which was cool to see. YMAX down a lot compared to VU. ORR just slightly over the green as well. IALT held up nicely this week as well. Goop down a lot, as we mentioned. And BTC just kind of held neutral. Blocks went up a lot this week, which is interesting to see. This was the highest in the green, looks like, between its dividend and its capital gains. And DRAM just eked out slightly positive this week, despite its previous week's lows. So that's where we're sitting. As far as the dividend calendar this week, so we're still trending towards 5.7K this month, which is awesome. This week we made about, if we just calculate this out, so 450 on Friday, 675 on Thursday, and 76.94 on Monday. So made $1,203 this week, which is awesome. So that was $76 on Monday from blocks, $44 from blocks at 37% yield, $32 from GIX at 25% yield. Chippy was $353 at 40% yield. ULTY $165 at 62% yield, and YMAX at $107 at 49% yield. And by the way, these weeklies, what I'm doing with these is I'm taking those and then reinvesting it into the safer yielders. So I'm basically kind of taking money that I'm getting from the ultra yielders here and then reinvesting it in anything in the anchors and doing that weekly now. And then got my Goop payout here, so $49 at 15%. And then on Friday, got my BTCI payment at $246 at 27% and MLPI at $203 and 14% yield. So nice week overall. So $1,200 this week. So definitely averaging over like a K every week, which is cool. And then next week we have our last one. So capping off our 5 weeks of payouts this month in July. That's always nice. So 5 weeks of payouts and even 5 weeks of paychecks for me, which is cool. So that's where we're sitting. If we dive into the dividends a little bit more, can kind of see, the yield on cost, right? So as we talk about NAV erosion, right? ULTY and YMAX, you kind of just clearly see that here with their prices going down and being in the red and their unrealized gains, their payouts are going down accordingly. So on a week, I might get 62% yield, but given all the capital I have in it and the cost basis, it's actually more like a 33% yield on all that capital. And YMAX, I'm getting a 49% yield, but with the yield on cost, it's sitting more like 27%, right? On yield on cost. So definitely things to keep in mind if you're invested in those. There are trade-offs and there are risks. But as I'm saying, I'm just holding on to them and then just investing its dividends into safer yielders here. So anywhere ones here that are in the middle part here that hold their yield a lot better, even as kind of things go down a bit, that's the yield on cost here. And then by the way, if you want to see this for yourself, you can always look at my free Snowball portfolio link in the description below, and also have my referral link for Snowball if you want a bit of a discount and I think extended free trial, and I get a bit of a kickback too. See all these same numbers, nothing's hidden. Love sharing all this with you guys. If we check on July, we've officially passed last year's July dividends, which is awesome. So next week we'll push us even higher. August next month, I think will be a harder one to beat. It looks like we're trending towards 5.1K a month next month. So I don't know if we're going to beat that one. That would take something crazy, like one of the weeklies jumping for some reason, which I doubt will happen. But I think the next few months will be harder to beat. I'll definitely beat September. Looks like October. I'll beat October, which is great. October here. This was 6.4 last year. No, I'm not going to beat it. And then November, I'll be beating that. And then December, we'll definitely be beating that, I think. Yep. So October, I think that was like a 5-week payout week. And then plus that, I was just doing a lot more of like higher yielders last year. So not quite going to beat that, but cool to see that for the rest of the year. Apart from October, I've pretty much beaten out last year's payments. So kind of seeing the system at work, and the full paycheck investing is really increasing the dividend payouts every year and every month. So just cool to see the comparison. That's the numbers there. As far as portfolio thoughts this week, there was a good suggestion from JG3 in my last video. It was like, oh, maybe 50% of your high yield payment buying the dip, which I've been doing, right? I'm doing more closer like to 100% of that payout. But then maybe another 50% where it's buying a little bit of everything. And it's not a bad idea. I've been honestly thinking about it in the back of my head for a little bit, just because I have been buying just mostly like what's low on any given week. But it could be nice to, just be a true DC and to be really DCAing whether stuff is up or down and potentially doing that. So I might maybe give that a shot next week, honestly, with next week's paycheck. So maybe 50% goes to whatever in the anchors are particularly low that week. Like, I don't know, like say KCOP is very low that week or goes down a lot. Just buying like 50% of my kind of like 2K or whatnot that's left for the high yield. And then another K just kind of gets split equally between XPAY, MLPI, TSPY, TDAQ, things like that. So I'd give that a shot next week just to change things up. So good suggestion there, JG3, thanks. And he's a great active member in our Discord. So if you ever join, you'd be definitely interacting with him and learning from him and tons of others as well. And then another thing I've been thinking about, so just musing, not necessarily actioning on anything of this yet, But I was playing around with like, what if I potentially just condense a little bit the growth side of things even more? So potentially just kind of sticking to potentially VGT, AVLV, and SPMO, and then maybe selling QQQM, putting that into VGT, and then VU and putting that into AVLV potentially, or maybe even SPMO. But I was kind of toying with that idea, and I was kind of curious how that would have back tested performed. So I saved some things here. So this is my current growth stuff. I kind of have that there. And then I have VGT, AVLV, SPMO, even VGT, VU, SPMO. And I just wanted to backtest that to get an idea, right? And then even like right now, so let's actually just use the money that I have right now just for funsies. So that's 142.6K. So let's just do that just for fun. And you can kind of see that VGT, AVLV, SPMO would have performed quite nicely. Would have a little bit more beta than my current setup, and a little bit more volatility, as you can kind of see here. But its max drawdown would actually be lower, which is cool to see. And its CAGR would be at roughly 18%. So you can see how it would have performed there. So my current one definitely dragging, right? And then if we check on returns just to compare, right, year to year, I like this little view here that they have. And particularly which is cool to see, right? You can see that like this combo would have been outperforming this year. This about matched. And actually, oh, sorry, let me also add VU here just for comparison. Good to have to see how you're doing against the market. So you can kind of see it definitely would be outperforming the market every year so far. And even what's nice to see is that in 2022, with the tech downturn that we had, this portfolio would have just held up nicely against all of those, right? And I think that's probably thanks to AVLV and definitely a little bit of SPMO as well too. But it's cool to see that it would have dropped less than the market did that year. And in 2021, just underperformed the market here a little bit. But interesting to see. A good thought experiment and just exercise to see potentially. I'm kind of mulling this over if it's even worth it, or just it's not that many on the growth side. If anything, there's more on the high yield side that I should probably consolidate. And I'm still thinking through some of that, right? Like I've talked about potentially consolidating BTCI into blocks, but I just want to see how blocks performs a little bit more just for myself. So far, so good. I've definitely been impressed by it. And like, I mean, even if we go compare, and I'm going to take out total returns just so we can factor out dividends here and just look at pure price appreciation. Blocks has just been killing it when you look at it. So it definitely follows crypto and Bitcoin as a whole, but because of its other stuff that's not crypto per se, Robinhood, Nvidia, that's crypto related, but not quite crypto, it helps buoy it up compared to normal crypto. So price-wise, I definitely, if I was just fully in blocks, I'd be dropping. It's a lot more volatile for sure. You can kind of see it here, right? Almost 3 beta, a lot of volatility, 54%. But it gets more of that upside. And then also you can kind of just see that its price is holding up a lot better, right? Compared to crypto. So that's been interesting to see. And I just want to see this a little bit more before I kind of pull the trigger on that. So, but it would be a little bit more diversified as far as kind of crypto exposure goes. Could potentially be interesting. And as a little bonus too, blocks would pay a little bit more of a yield compared to BTCI as well too. So that'd be nice on top of the better price appreciation potentially, because yeah, it uses credit put spreads as well to have that capped upside similar to OVL and to GIAX. This is one I'm still kind of mulling over. That's potentially one that I'm looking at on the high yield side. I would have to be realizing a bunch of these losses too potentially, which honestly would be kind of like offset by a lot of the gains that I realized for when I sold SCHD the other week. But still thinking that through. But just want to be totally upfront and see a glimpse into what I'm thinking about a little bit. And as far as that question that I mentioned, so if we pop over to Miro here. So I had this valid question from TB Asian Eyes. How are your bills 8K per month? If you're serious about retiring early, you should reduce your spending. And honestly, fair. I think like 8K a month's a lot. One thing, and I gave a bit of a response here. So I live in a high cost of living area in Washington. So just my fixed monthly bills are 5.8K a month. So that's like 2.5K for the mortgage. And then just all the bills that come related to the house and just stuff that's fixed and that can't really come off really. So that's how things like on top of like just like guilt-free expenses, like that things may vary between 7 to 9K a month expenses wise. But honestly, I love living in Washington. I love living in my house and owning my house. So I'm fine with building up my portfolio to a level that will support the lifestyle that I enjoy. Like I personally don't want to slum it and kind of never go out to eat at restaurants, never go do fun stuff and not enjoy life to cut my expenses to the bone to kind of retire early. Like That's kind of what I like from this strategy. It's like best of both worlds, where like I'm really investing my full income, but I'm also still enjoying life as I'm doing it. I'm not like really slumming it to hit like classic fire like some people do, and nothing wrong with that. More power to you if you're fine with doing that. Personally, I don't want to do that. So that's long and short of it, right? It's a high cost of living area, and I'm fine with building up my income to support the lifestyle that I want. I don't want to compromise that. And that's me. And as Frank too, that's kind of all relative, right? I have my house that I own, I have a high paying job, but also maybe I should do it more often. But every year, at least at the beginning of the year, I do take a hard look at like all my expenses generally. And I do a lot of that with like kind of Monarch. On Monarch, for example, I kind of go month by month and really look at like what's really eating stuff up. Have kind of stuff split up: fixed costs, guilt-free spending, shared costs. This is stuff that I would be splitting with my wife, and then fixed costs for pets. And oh, this one actually I need to fix. This shouldn't be there. It basically splits into these categories. So generally try to look what's costing, what might need to cut or removed. I tend to do that at the beginning of the year. And I actually did one when I got laid off. I actually did a culling pass of like stuff that I had to take a second look at to help cut down on monthly expenses. But a lot of the stuff is mortgage stuff. And we'll go over this next week when we go over the monthly update. We'll have a full breakdown of all this stuff. So stay tuned for that. But hopefully that answers your question, TB Asian Eyes, if you watch this again. But otherwise, it also answered your comment. As usual, if you want to support the channel, best way is to check out the description below for any video. You'll see all my free and paid links. You'll see the links to my Patreon for $3 a month to get access to the Discord. My spreadsheet, if you're interested, for $5 one-time fee. If you want access to this to track your stuff manually, no weird putting in your info to sync or whatnot. You just kind of handle all yourself. So all offline. And if you appreciate all this transparency, make sure to give a like and subscribe. And I'll catch you in the next video. If you haven't seen Friday's full paycheck investing video, definitely check it out on the bottom left. Peace.